It's just really common sense investing. It's not rocket science. And then you've got to assess the valuation. Where's it going? Where could this business get to? And at the moment, that bit has been harder work because you've had a lot of really irrational selling.
Hello and welcome to episode 2 of the Professional Investor Podcast, the series where we go inside the mind of a UK-based professional investor. I'm Jonathan Bramall. Our guest today is Chris Boxall. Chris has returned after joining us for our debut episode. He is co-founder and portfolio manager at Fundamental Asset Management. He has 25 years as a professional investor under his belt, having worked in New York as well as in the UK. In today's episode, I'll be asking Chris how he constructs an investment portfolio. Chris will speak about his strategic investment approach, risk, research, the key criteria he looks for in a company, his strategy around diversification, including a sector he stays away from, as well as some of the challenges there are in the market at present. To go into some specifics, Chris will focus on his specialism, companies listed on the notoriously volatile AIM index. This podcast, all opinions and information are for educational purposes only and do not constitute investment advice. Trading and investing carries a high level of risk and are not right for everyone. If you need financial advice, consult with a regulated financial advisor in your country before making any decisions. Thanks for joining us on the podcast today, Chris.
Hello, good to be here as always.
Thank you. We're covering the topic today on how do you construct an investment portfolio. What is your strategic investment approach when it comes to portfolio construction?
I assume here we're only discussing our AIM portfolios. I think probably we should make things clear because that's obviously quite a tight, concentrated focus. But I think from portfolio construction, we're starting with that. So broadly, as an investment manager, clearly we're addressing smaller quoted companies, growth companies. So our outlook is we're a growth. We have a growth mindset. What I would say, this value overlay to it as well. We are addressing in AIM and in smaller quoted companies, the key criteria for us is they have to be profitable, cash generative, and really profitable. We don't like any of the fairy tale adjusted EBITDA. Can't stand that. We like to see real profits reflected often in the cash flow and free cash flow if possible. And from a broadly 770 odd company universe, overall universe, our investable universe is realistically somewhere in the region of 250 to 300 stocks on AIM. And from there, we try and drill down and create a basket of around 30 to 35 companies that are in our selection basket.
And do you view those selections as sort of a similar risk? How do you approach that side of construction?
Risk is a tough one. For some people, risk equals volatility, which is wrong. The risk in smaller quoted companies is at the extremes if they go bust entirely. That has diminished massively over the last 20 odd years that we've been investing in AIM, principally for inheritance tax planning purposes. AIM has now far fewer companies, and if anything, and this may sound weird, but if anything, it needs to be riskier. At the moment, it isn't really risky enough, in our opinion, and we haven't had enough newcomers, so there's less chance of total wipeouts at the extreme that we had, say, 10 years ago. AIM was far riskier and selection was a lot tougher. Here you've got a greater concentration of good companies. Essentially, they're less risky, albeit that there have been some headwinds, and there is has been a great dislike of smaller quoted companies over recent years, not just in the UK, in the US as well, and across Europe. Everybody hates small caps. Everybody hates the UK stock market, full stop. But small
Sure.
caps are firmly out of favour.
Absolutely. And if it comes to, let's say, IPO, you approach that the same as a longer traded company, or
we don't like investing in IPO in our AIM IHT book. We like to see companies, and unfortunately there haven't been many IPOs of late. We generally like to see companies establish themselves on the stock market, prove themselves, deliver real results. Typically companies come to IPO, they're packaged for sale. Everything's been perfect. They've been enjoying marvelous trading, growth, double-digit growth for a number of years, and typically maybe private equity selling out, or the founders deciding to take some money off the table, and they're often they've been priced to perfection. And we saw that in 2021, where you had a lot of online retail offerings, many of which whose business models have been found wanting. So yeah, we generally try and avoid IPOs unless there are very compelling reasons to go for them, and if the valuations look very attractive. So we'd like to see companies prove themselves on the stock market first, in the glare of the public. That's essential for us.
In terms of getting your information, how do you approach that? Where do you go? Do you buy information from external sources? How does it work?
Well, AIM companies and smaller companies in general are very poorly followed. Typically, many may only have the house broker offering research, and that's not very independent or objective. But it does provide a guide, and that's created after the broker has liaised with the company's management. Typically, results as well are absolutely riddled with adjustments. There are very few AIM companies now who announce results, their financial results, without loads of adjusting items, and the brokers are often reflecting only adjusted items as well. So investors have to take a very close look at what items are being adjusted. For that reason, we like to look at the cash flow, but we look at all the financial results. We generally go through the financial results of nearly every AIM company that is conceivably in our universe, those 250 to 300. That we can, there's something to look at. We then sort of look around the edges as well at industry noise. We look at through things like Glassdoor, which can offer a guide as to employee satisfaction as well. There are all sorts of little aspects, anecdotal or otherwise, that we sort of try and have a look at and then bring them to bring more information to bear in our selection process. But really, the starting, we like to see firm numbers. We try and avoid the chit chat of the results. We like to look at those numbers and see how they're going to pan out, and then we try and assess and project going forward how the cash flow, typically the discounted cash flow, is going to grow over the the next few years. That can be difficult for AIM.
Do you get any nods and winks from Twitter, X as it's now known, or from chat rooms as used to be used
we
in the
do.
old days?
There's loads. We look at some. We don't dismiss anything. I mean, some of the chat rooms, you have really intelligent comments, very considered comments. Others, it's less considered and just noise. But the problem is, you eventually get information overload. You finally have to take a decision, and that's quite hard, because there might be sort of conflicting views, and often, I mean, valuation's a big sticking point. Less so now, but it can be. Shares look quite fully priced. Are they still a buy? I mean, the nature of AIM is these small companies can get an awful lot bigger, and just because a business is sort of doubled, or it may have been worth 50 million, now it's worth 100, it could go on to be 10, 20 times that size. It would still, even at 20 times, it would be in sort of US parlance, it will still be a small company. So yeah, it's different. We try and assess a lot of the news, and so yeah, we don't dismiss the chat rooms out of hand.
What are the key criteria you look to? You mentioned ignoring EBITDA and so forth, but what's your key criteria that you're
So at the basic level, our AIM IHT book has to be invested in profitable cash generative companies, as I mentioned. So that means that we may miss out on early stage ones that ones that are still progressing a little bit, whose shares may be rallying, and we may we also avoid the super speculative, and some of those have delivered pretty good returns. We then like to see, typically, and I'm generalizing here, obviously, but we then like to see significant, in many of our stocks, significant insider family management ownership. We don't like management selling down unless there's a good reason, and a good reason could be they simply have too many shares. I mean, if a management's got one stock we look at got circa 50% of the stock, that's too high. So we appreciate they need to sell down. We like to look at cash flow. We like prudent balance sheets. We don't like too much debt. Some of our companies carry debt, but that's very, very manageable. Cash flow for those is generally excellent. But net overall, our companies in our universe are carrying a strong net cash position typically. Yeah, so actually, it's just really common sense investing. It's not rocket science. And then you've got to assess the valuation. Where's it going? Where could this business get to? And at the moment, that's been that bit has been harder work because you've had a lot of really irrational selling. I mean, small caps have just been sold down. If there's a rumor of something going on, you may see a huge sell-off, despite which doesn't reflect really the impact, the likely impacts on its business. And one thing, with that in mind, one of our stocks, CVS Group, a veterinary services group, is subject to a CMA. The veterinary services sector is subject to a CMA review, and that's seen the shares fall off significantly. Far above,
Right.
in our estimation, any decline in profitability that may result from a even negative outcome of the review.
I'm with you. So if you see a stock that by your analysis is oversold, are you nevertheless saying, well, the market's got it wrong, but we're going to respond because it's been oversold so much that we're
Yeah,
going to
yeah,
get out, or
yeah.
do you stay the course?
No, we stay the course, and if new clients come in, we'd be buyers. If we're comfortable and we
Right.
feel it's oversold, we'd definitely be buyers. Um, the you know the difficulty in managing sometimes, if something gets oversold, is it going to be is it going to get worse in the short term? Well, it might be possibly, but we're equities a long game, and if we feel in a year or 2 years you're going to see a greater return from that oversold stock than if we would get out and reinvest, deploy the capital elsewhere, we will stick with it, which we have done. Um, yeah, so it can hurt you in the short term, but we feel that that the long term rewards outweigh that.
What at fundamental asset management is your house ethos? Are you looking at growth overlay? Are you sort of looking
Yeah,
at
very much. We're very much a growth. Smaller companies in AIM is a growth market, and we run now two types of portfolios, both a growth portfolio and AIM. I'm talking just about AIM, but also an income portfolio. However, the income portfolio has a higher dividend yield. Dividend yield is just over 5 odd percent. The growth portfolio is circa 2% and a bit. However, even the income stocks per se are still growth. There are still growth stocks. I mean, one of them is forecast to grow its earnings about 20% next year. So, and it's yielding circa 5%. So you can see you're getting a bit of both. So that's the valuation really appeal of AIM at the moment. It looks, many companies look incredibly attractive. So you're picking up income and growth at a far more reasonable price than you did a few years ago.
I see, but in effect, therefore, based on what you've said, is it fair to assume that if you hear that this company's got a lot of buzz around it and you think the stock price is going to go up, but you actually don't like the business model, or it's doesn't appear to be built on firm enough foundations, are you going to ignore that stock even if you
Yeah,
think that potentially there's going to
if there's total rubbish being spoken and we've got a negative view, despite the fact it's going out and all the noise is saying, oh, it's the next best thing, sliced bread or whatever, we won't be a buyer of it. We stick to fundamentals and avoid the noise. There's got to be some common sense basis underpinnings of why the shares are going up, and if we think that's just a false rumor, inaccurate, and there's without basis of truth, we're not going to be buyers. We're far from momentum traders at all. And I should add, it's very hard to trade when you're managing in AIM for IHT and in AIM at all at an institutional level. Even with our size of book, which may not be massive, but for a small cap market, it's still harder to manage. You can't keep jumping in and out. Because remember, if we do it for one client, we've got to do it for all of them.
And how do you approach diversification?
We like to run a reasonably diversified book. So larger portfolios would have typically 30 odd holdings. Smaller ones around, starting point is only £40,000 may have 20, 25 stocks. And typically the way we like to structure it is around a core satellite approach. So we have 80% of the portfolio is made up of so-called core holdings, typically larger AIM companies, more liquid AIM companies. So they make up the majority of our overall AIM AIM book, whereas the 20% may have some smaller ones, or where we're just starting to buy into a stock. So a satellite holding may eventually move to a core holding. But typically the satellite holdings are smaller companies that may be a bit less liquid, or that may be lower growth. They may offer up a greater dividend yield, which helps the income on both the growth and the income accounts. But yeah, on a growth portfolio, we obviously need to generate some income to help pay for the management fees as well for managing the account.
And when it comes to different sectors and different industries, are there things that you're wanting a certain split? Do you have sort of prerequisite in mind in terms of different industries that you want the portfolio to cover?
We avoid resources generally for reasons that many of them don't qualify anyway for business relief purposes, but we avoid resource early stage bio and pharmaceutical, typically because they're early stage and not profitable. Real estate as well, we would typically avoid. But other than that, we're fans on the technology sector, software. We love good software businesses that have wonderful recurring revenue, great returns on capital as well that they can offer. But yeah, other than that, we're pretty well spread with no specific sector to bias, other than perhaps technology and related is the core. Although nowadays technology steps over so many sort of lines. I mean, you could say we hold shares in an automotive engineering company. We've held them for a long time, but it's offering it has a technology aspect as well. It's moving into even pure software areas. So these companies now straddle markets and sectors, I would say. I would add as well, we're not that keen on the dining out sector. And there are quite a few restaurant groups on AIM, cafe groups, and we're less fans of those, and notably those addressing just the UK market. We see few barriers to entry really for them, and it hasn't been a happy hunting ground for us.
In terms of your investment process, then you've gone through a lot of that. I don't know if there's anything else you want to add, or for example, whether that includes meeting with management or how you approach that side of
we like
process.
we like meeting with management initially to fully understand the business model if we feel it's hard to understand, and that can add value. However, ongoing, my opinion, it adds far less. We prefer to, rather than listen to what they're saying, we prefer to focus on what they're reporting and the facts. Yes, but saying that, if there are doubts, if there are queries, we'll call for another meeting with management to get a better understanding of how things are going. But I repeat this on countless occasions. I've never heard a bad story out of management ever, to the extent that I've heard some wonderful stories a day or two before the company's going bust. So we prefer to focus on what they're reporting on the facts and on the numbers and the market, the assessment of the market as well. But yeah, sometimes it can add value. That's true.
Is there any top tip that you keep in mind, or what's the thing you would always say is one of your main strategies or important process that you always think is a vital thing to follow?
I think our process has remained fairly constant since we've started. I think AIM now, as I said, is a far richer hunting ground in terms of there are a much better concentration of good companies. Unfortunately, there aren't enough companies, so we need a few more coming on them. That's disappointing. In terms of valuation, I mean, valuations at the moment for our AIM book have never ever looked as attractive as this. We did a quick trawl through the estimated free cash flow yield, which is a key measure for us. Free cash flow, that's the free cash, the benefit the company generates after it's made all its capital expenditure. And our free cash flow yield, simple average, is touching 6%. And I know there are some companies that skew that a bit, and you'd have to get 1 year from the next, and we're coming out of the pandemic era as well. But that's unbelievable. I mean, that's way higher than it used to be. That's the free cash the company generates relative to its market capitalization or enterprise value. So the enterprise value is the market cap plus the debt on it. So that's incredibly high. So valuations look great. The harder thing over recent months is when you see, as we brought up before, if you see a big sell-off, what do? Where can you redeploy capital elsewhere to a greater extent, or just stick with that holding? First of all, it's been very hard to get out of the stock anyway. So even if you can, you're probably going to take a leg down. And you think, well, I actually think in a year's time, this stock will be double where it is. Well, you stick with it. Where else can I double and maintain the balance to the portfolio I need and avoid too many excessive trading costs? And so that's been quite a tough discipline lately.
And in a nutshell, Chris, what is the fundamental asset management process?
Well, I think we probably do what we say on the tin, as it were. Our name covers it, really. We're all about fundamental analysis, as the name suggests. And we like looking at the fundamentals, albeit with a little vision to the future as well. But yeah, it's all about the numbers and the reality for us, rather than any fairy tale reporting that companies like to bring.
That's great. Thanks very much for your time, Chris.
No, pleasure.
Well, I hope you enjoyed that look behind the curtain into the world of a professional investor and how a portfolio is constructed. We will add where to find Chris online, as well as some other links to the show notes. We have some great episodes coming up covering other aspects of being a professional investor, so please subscribe to The Professional Investor wherever you get your podcasts so as not to miss out on future episodes. If you found anything useful, please leave us a review, as it really helps us get the podcast out there. Thank you for listening.